Warren Buffett wakes up every morning at 6:45 a.m. Not to check the stock market, not to attend meetings, not to make deals. He reads. For 5 to 6 hours straight, Buffett consumes 500 pages. Every single day. He's been doing this for over 70 years. That's roughly 185 pages per year. Over 7 decades, that's nearly 13 million pages. When asked about his success, Buffett doesn't point to his investment strategy or his business acumen. He holds up a stack of papers and says, "Read 500 pages like this every day." That's how knowledge works. It builds up like compound interest. Today, Warren Buffett is worth $120 billion. He's arguably the greatest investor who ever lived. Berkshire Hathaway, the company he built, is worth over $900 billion. But here's what most people miss. Buffett's success has almost nothing to do with being smart about stocks. He himself admits, success in investing doesn't correlate with IQ. Once you have ordinary intelligence, what you need is the temperament to control the urges that get other people into trouble. So what is this temperament? What mental framework allows someone to turn $10,000 into $120 billion? That's exactly what we're breaking down today. The 3 psychological principles that separate Warren Buffett from every other investor on the planet. And more importantly, how you can apply these same mental models to any decision in your life. Before we dive in, let me be clear. This isn't a video about stock picking or investment tips. I'm not a financial advisor. And this isn't financial advice. What we're examining is far more valuable. The actual decision-making framework. The thinking process that allowed Warren Buffett to outperform nearly every investor in history. Because here's the truth. You don't need to be interested in investing to benefit from understanding how Buffett thinks. His mental models work for business decisions, career choices, relationships, health. Any area where you need to make important decisions under uncertainty. Today, we're reverse engineering 3 core principles. Number 1, Circle of Competence. How Buffett eliminates 99% of opportunities to focus on the 1%, where he has an unfair advantage. Number 2, the power of compounding. Why Buffett's obsession with time and patience creates exponential results while others chase linear gains. And number 3, emotional discipline. The psychological framework that allows Buffett to stay rational when everyone else is panicking or euphoric. By the end of this video, you'll have a framework that's been tested over 70 years and proven to work across billions of dollars in real-world applications. One quick note. I've created a 1-page decision framework based on Buffett's principles. It's a simple checklist you can use before making any major decision. Link is in the description. Grab it now. So it's ready when we get to the practical section. Now, let's start at the beginning. Who is Warren Buffett really? And what shaped the mind that would eventually master the art of compounding wealth? Warren Edward Buffett was born in 1930 in Omaha, Nebraska, during the Great Depression. His father, Howard Buffett, was a stockbroker who lost nearly everything in the 1929 crash. Young Warren watched his family struggle. He saw his father's business fail. He understood viscerally what financial insecurity felt like. But instead of being paralyzed by fear, Buffett became obsessed with understanding money. At age 6, he bought 6 packs of Coca-Cola for 25 cents and sold individual bottles for 5 cents each. A 20% profit margin before he could multiply. At age 11, he bought his first stock. 3 shares of City's Service preferred stock at $38 per share. The stock immediately dropped to 27. Buffett panicked, but he held on. When it recovered to $40, he sold, relieved to make a small profit. Days later, the stock soared to $200. That moment taught Buffett his first major lesson. Patience beats panic. Short-term thinking costs you long-term gains. By age 13, Buffett was filing his own tax returns, reporting income from his paper route and pinball machine business. By 15, he'd saved $6,000, equivalent to about $90,000 today. Most teenagers spent money on entertainment. Buffett was reading investment books and calculating compound interest curves. At age 19, he read The Intelligent Investor by Benjamin Graham. This book changed everything. Graham taught a concept called value investing, buying stocks for less than their intrinsic worth, and waiting for the market to recognize the value. Not speculation, not gambling. Mathematical analysis combined with patience. Buffett later said, "It was like a religious awakening. Everything clicked." He went to Columbia Business School specifically to study under Graham. After graduation, he worked at Graham's investment firm, learning the craft from the master himself. But it was after leaving Graham that Buffett developed his first core principle, the Circle of Competence. Here's what this actually means. Most investors try to know everything about every investment opportunity. They spread themselves thin, chasing hot tips, following trends, jumping between sectors. Buffett does the exact opposite. He defines a very specific circle. These are the industries, business models, and company types he deeply understands. Inside that circle, he has an unfair advantage. Outside that circle, he doesn't invest. Period. In his own words, you don't have to be an expert on every company or even many. You only have to be able to evaluate companies within your circle. The size of that circle is not very important. Knowing its boundaries, however, is vital. This is profoundly different from how most people operate. Most people see an opportunity and think, could this work? Buffett asks, is this inside my circle of competence? Do I understand this better than most people? If the answer is no, he passes, no matter how good the opportunity seems. During the dot-com bubble of the late 1990s, everyone was getting rich on tech stocks. Amazon, eBay, thousands of internet companies were soaring. Friends told Buffett he was missing out. The media called him washed up. Buffett's response: I don't invest in things I don't understand. He stuck to his circle. Insurance companies, banks, consumer goods, businesses with predictable cash flows and understandable economics. When the bubble burst in 2000, those tech stocks crashed. Companies worth billions vanished overnight. Buffett's boring investments kept compounding. This principle, Circle of Competence, is rooted in deep psychological research. Daniel Kahneman, the psychologist who won the Nobel Prize in economics, spent decades studying decision-making under uncertainty. His research proved that humans consistently overestimate their knowledge and ability to predict outcomes. This is called the overconfidence bias. Buffett avoids this trap by being brutally honest about what he doesn't know. He's not trying to be the smartest person in every room. He's trying to be the most knowledgeable person in his specific domain. And here's the key insight. You don't need a huge circle of competence to be successful. You just need to know where your circle ends. Think about this in your own life. What do you understand better than most people? Where do you have an unfair advantage through experience, study, or aptitude? That's your circle. Stay inside it. Say no to everything else. Buffett's partner, Charlie Munger, puts it this way. We have 3 baskets for investment ideas. In, out, and too hard. Most things go in the too hard basket. This creates incredible focus, while others are distracted by 1,000 opportunities. Buffett waits patiently for the perfect pitch inside his circle. Which brings us to his second principle. Because knowing where to focus is one thing. Having the patience to wait for the right opportunity, and then the discipline to hold it for decades. That's something entirely different. Let me tell you about Buffett's most famous investment. In 1988, Warren Buffett began buying shares of Coca-Cola. Over 13 months, he invested $1.3 billion, acquiring 400 million shares at an average price of £3.25 per share. At the time, people thought he was crazy. Coca-Cola had been around for over 100 years. How much growth could possibly be left? Why not invest in exciting new technologies? Buffett saw something different. He understood the business model perfectly. It was inside his circle. He saw a company with a product that people would buy for the next 100 years. A global brand with unshakable competitive advantages. Predictable, growing cash flows. Management he trusted. Most importantly, he believed it was undervalued. Not by 10% or 20%. Significantly undervalued based on its long-term earning power. So Buffett made the investment. And then he did something radical. He held it. For decades. Today, that $1.3 billion investment is worth over $25 billion. But it's not just about the stock price appreciation. Berkshire Hathaway now receives over $700 million per year in dividends. More than half of the original investment amount every single year. That's principle number 2, the power of compounding over time. Most investors think in quarters or years. Buffett thinks in decades. He once said, "Our favorite holding period is forever." This seems simple, but it's psychologically brutal to execute. Walter Mischel's famous Stanford marshmallow experiment proved that delayed gratification, the ability to resist immediate rewards for larger future gains, is one of the strongest predictors of life success. Children who could wait for 2 marshmallows instead of eating one immediately went on to have higher SAT scores, better health, and more wealth as adults. Buffett is the adult version of that disciplined child, but magnified over 70 years. Albert Einstein supposedly called compound interest the 8th wonder of the world. Whether he actually said it or not, the principle is profound. Here's the mathematics. $1 growing at 10% per year becomes $1.10 after 1 year. Nothing impressive. After 10 years, it's $2.59. Still modest. But after 50 years, $117.39. The magic isn't in the rate, and it's in the time. Buffett started investing at age 11. He's now 94. That's 83 years of compounding. Here's the shocking stat. 99% of Buffett's wealth was created after his 50th birthday. Not because he suddenly got smarter, because compounding accelerates exponentially over time. If you graph Buffett's net worth over his lifetime, it looks like a hockey stick. Decades of slow, steady growth, then an exponential curve upward in later years. This is why Buffett is obsessed with not losing money. His first rule of investing: never lose money. His second rule: never forget rule number 1. It sounds like a joke, but it's deadly serious. Because every loss resets the compounding clock. If you lose 50% of your money, you need to gain 100% just to break even. That's years of compounding erased. So Buffett doesn't take unnecessary risks. He doesn't chase home runs. He focuses on avoiding strikeouts. This is radically different from the modern investment culture of day trading, crypto speculation, and get-rich-quick schemes. Darren Hardy's The Compound Effect explains this perfectly. Small, smart choices plus consistency plus time equals radical difference. Buffett makes this concrete with his 20-slot rule. He tells students, imagine you have a punch card with only 20 slots for investments in your entire life. Every investment you make punches 1 slot. Once you've used all 20, you can never invest again. This mental model forces you to be extraordinarily selective. No more chasing every shiny opportunity. No more FOMO. Only the absolute best ideas make the cut. In practice, Buffett hasn't used anywhere near 20 slots. The majority of Berkshire's value comes from about 10 major investments, made over several decades. But compounding doesn't just apply to money. It applies to knowledge. Remember Buffett's reading habit? 500 pages per day for 70 years. That's not just information accumulation. It's knowledge compounding. Each book builds on the previous ones. Patterns become clearer. Frameworks strengthen. Understanding deepens. Cal Newport in Deep Work argues that knowledge workers who can focus intensely on complex problems will increasingly dominate. That's exactly what Buffett does. 6 hours of daily reading is 6 hours of deep, focused learning. And here's what makes this accessible to you. You don't need 70 years to see results from compounding. You need to start now and let time work for you. Whether it's learning a skill, 1% better every day equals expert in years. Building relationships, consistent investment equals deep trust. Growing wealth, regular savings plus modest returns plus decades equals financial freedom. Developing knowledge, daily reading plus retention plus application equals rare expertise. The principle is the same. Small actions, repeated consistently, compounded over time. The framework is yours. 3 principles, 5 actions. 70 years of proven results. What you build with it is up to you. Next video, we're going deep on Jeff Bezos. Subscribe and turn on notifications so you don't miss it. If this video added value, hit that like button. And comment below, what's your circle of competence? What's one thing you're committing to compound over the next year? I read every comment. See you in the next one.